President Trump has deferred military strikes on Iranian energy infrastructure for 5 days, triggering a temporary relief rally across major indices. While the news sent crude oil plunging 10%, 42 Macro notes this bounce is tied to a specific 5-day window. It raises the question of whether today's market action is a genuine turn or just a brief pause in geopolitical tension.
The geopolitical reprieve sent crude oil futures plunging 10% today, as headlines of potential U.S.-Iran progress sparked a wave of relief. But while the headlines are shifting, the technical reality remains cautious. Investors Business Daily notes that despite today's bounce, major indices like the S&P 500 and Nasdaq still finished below their 200-day moving averages. This failure to reclaim key resistance suggests that the broader technical downtrend is still very much in play.
Yields remain a central concern as the 10-year Treasury stays above 4.3%, acting as a steady headwind for growth stocks. Investors Business Daily reports that the earliest window for a confirmed market uptrend doesn't open until Thursday. Until we get that follow-through signal, the technical outlook suggests caution, as the failure to reclaim key levels indicates that institutional selling pressure may still be a factor.
Moving from market timing to macro policy, the Federal Reserve strategy is shifting away from a pure easing bias. 42 Macro reports that the Fed's reaction function has entered what they call a bimodal distribution, meaning rate hike risks are officially back on the table if inflation flares up. Chicago Fed President Austin Goolsbee recently indicated that policy is now tied directly to geopolitical developments and their impact on global energy prices.
While the U.S. faces these mounting pressures, 42 Macro notes that China is providing a significant liquidity buffer to the global system. Its expansion measures are currently up 27% on a 3-month annualized basis. This global offset is the primary counterweight now that the era of guaranteed rate cuts for domestic investors has likely ended. From here, the trajectory depends on whether the current geopolitical window leads to a lasting de-escalation in the energy markets.
SoFi is currently facing a significant challenge to its accounting integrity, according to Unrivaled Investing. The short seller alleges SoFi overstated its profitability by $1 billion, largely by using an aggressive 3.89% discount rate to value its student loan portfolio. Since that rate is notably below the 10-year Treasury yield, the report argues SoFi is creating artificial paper gains rather than real value.
The short report also challenges a $312 million transaction that management recorded as a loan sale, arguing it may actually be a collateralized loan from J.P. Morgan. To counter this scrutiny, CEO Anthony Noto stepped in with an insider purchase of up to $1 million in SoFi stock. While Noto's buy signals internal confidence, it hasn't silenced the broader debate over balance sheet transparency and the true cost of the company's loan portfolio. Moving from bank stock risk to private credit, Blackstone's flagship $83 billion fund, B-CRED, has reported its first monthly loss since 2022. Eurodollar University notes that the decline was driven by wider credit spreads and unrealized marks on individual holdings, such as Medallia.
Beyond this specific fund, the concern is the impact on the broader $4 trillion private credit market. Eurodollar University suggests this loss crosses a psychological threshold for investors who previously viewed these assets as immune to volatility. If that perception fails, a loss of trust can trigger a self-feeding liquidity spiral, where rising redemption requests challenge a fund's ability to maintain stable valuations. This marks a potential regime shift, shifting the focus away from interest rate moves toward deeper systemic credit and liquidity risks.
The Fed is proposing a plan to simplify capital requirements for the largest banks, setting up a regulatory tug-of-war. Heresy Financial explains that this G-SIB deregulation could free up room for share buybacks and dividends, though new rules requiring banks to reflect unrealized losses might paradoxically restrict their buying power and pressure Treasury yields. In the ETF space, the annual rebalancing of SCHD is now complete. According to Dividendology, the fund added names like United Health and Procter & Gamble while cutting its energy exposure to 16%.
Turning to the broader economy, Benjamin Cowen warns that U.S. payroll growth has stalled at 0.09%. This drop-off puts the labor market on the edge of a recessionary cliff. While jobless claims haven't hit critical levels yet,
This freeze in hiring is a major signal that the labor cycle may be nearing a turning point. To find opportunities in this environment, Investors Business Daily is highlighting Rush Street Interactive. The stock is showing distinct relative strength and recently broke out of a double bottom pattern. Even with the breakout, the channel suggests waiting for a confirmed market follow-through before you look to increase exposure. Finally, Jeremy Grantham of GMO is sounding the alarm on the AI investment cycle. He suggests we're seeing a repeat of the dot-com era, specifically comparing NVIDIA to Amazon in 2000. As Nana reports, the concern is that even if NVIDIA is a long-term winner, the record-high capital expenditure suggests a massive drawdown could be ahead. It places the market in a high-tension window, where temporary geopolitical relief is colliding with mounting credit risks.